Friends, I am Vijay Kumar, Deputy Secretary in the Government of India. This is my fourth talk on general financial rules. I will discuss Chapter 4, which is in 8 parts, namely Government Accounts from Rule 71 to Rule 87, Annual Accounts from Rule 88 to Rule 91, Proforma Accounts from Rule 92 to Rule 95, Personal Deposit Accounts from Rule 96 to Rule 97, Capital and Revenue Accounts from Rule 98 to Rule 103, Interest on Capital from Rule 104 to Rule 107, Adjustment with Government Departments from Rule 108 to Rule 122, and Inter-departmental adjustments from Rule 123 to Rule 129. For a better understanding of this chapter, please revisit my earlier talks. I have given their links in the description. First, government accounts. This chapter begins with Rule 71, which provides that accounts of the Union government shall be prepared every year, showing the receipts and disbursements for the year, surplus or deficit generated during the year, and changes in government liabilities and assets. The accounts shall be prepared by Controller General of Accounts in the Ministry of Finance, Department of Expenditure, certified by the C&AG of India, and along with the report of the C&AG on these accounts shall be submitted to the President of India, preferably within 6 months of close of the financial year. The President shall cause them to be laid before each House of Parliament. In terms of Rule 72, the Controller General of Accounts is responsible for prescribing the form of accounts of the Union and states, and to frame or revise rules and manuals relating thereto on behalf of the President of India. in terms of Article 150 of the Constitution of India on the advice of the C&AG. Rule 74 provides that government accounts shall be prepared on cash basis. This implies that the transactions in government accounts shall represent the actual cash receipts and disbursements during a financial year. Rule 76 provides that the accounts of government shall be maintained in Indian rupees. Accordingly, all foreign currency transactions and foreign aid shall be brought into account after conversion into Indian rupees. Rule 77 provides that the accounts of government shall be kept in three parts: consolidated fund, that is part 1, contingency fund, that is part 2, and public account, that is part 3. Part 1, that is consolidated fund, is divided into two parts: revenue and capital. In part 2, there shall be a single measure head to record the transactions under the contingency fund, which will be followed by minor, sub, or detailed heads. In part 3rd, that is under public account, transactions relating to debt other than those included in part 1, reserve funds, deposits, advances, suspense, remittances, and cash balances shall be recorded. Rule 78 provides that classification of transactions in government accounts shall have closer reference to functions, programs, and activities of the government and the object of revenue or expenditure, rather than the department in which the revenue or expenditure occurs. In terms of Rule 79, the list of major and minor heads of accounts of union and states is maintained by the Controller General of Accounts, which is authorized to open a new head of account on the advice of the C&AG under the powers flowing from Article 150 of the Constitution. Ministries and departments may open subheads and detailed heads as required by them in consultation with the budget division of the Ministry of Finance. Their principal accounts offices may open sub or detailed heads required under the minor heads falling within the Public Account of India. The object heads have been prescribed under Government of India's orders below Rule 8 of Delegation of Financial Power Rules. The power to amend or modify these object heads and to open new object heads rests with Department of Expenditure of Ministry of Finance on the advice of the Comptroller and Auditor General of India. Rule 83 reiterates the constitutional provision as in Article 112, Clause 3 of the Constitution. The expenditure covered under this article is charged on the Consolidated Fund of India and is not subject to vote by the legislature. All other expenditure made out of the Consolidated Fund of India is treated as voted expenditure. Charged and voted expenditures shall be shown separately in the accounts as well as in the budget documents. Rule 84, while defining capital or revenue expenditures, provides that these expenditures shall be shown separately in the accounts. Significant expenditure incurred with the object of acquiring tangible assets of a permanent nature or enhancing the utility of existing assets shall broadly be defined as capital expenditure. Subsequent charges on maintenance, repair, upkeep, and working expenses which are required to maintain the assets in a running order, as also all other expenses incurred for the day-to-day running of the organization, including establishment and administrative expenses, shall be classified as revenue expenditure. Rule 85 provides that the Reserve Bank of India shall be the banker to the government. It shall maintain cash balance of the government and provide banking facilities to the ministries and subordinate or attached offices, either directly through its own offices or through its agents banks. For this purpose, Reserve Bank of India shall, in consultation with the Comptroller General of Accounts, nominate a bank to function as a credited bank of a ministry or department. Pay and accounts offices and check drawing and disbursing officers shall have assignment accounts with the identified branches of the accredited bank of the ministry. All payments shall be made through these identified bank branches. These branches shall also collect departmental and other receipts Tax revenues of the government shall be collected by the RBI through its own offices or through the nominated branches of its agent banks. Rule 86 provides that Public Financial Management System PFMS, an integrated financial management system of Controller General of Accounts, Government of India shall be used for sanction preparation, bill processing, payment, receipt management, direct benefit transfer, fund flow management, and financial reporting. All grantee institutions shall submit utilization certificates on PFMS. Rule 87 provides that the process for implementation of direct benefit transfer should be adopted and transfer of benefits should be done directly to beneficiaries under various government schemes and programs using information and communication technology ICT. Necessary process reengineering to minimize intermediary levels and to reduce delay in payments to intended beneficiaries with the objective of minimizing pilferage and duplication should be done for all government schemes and programs. Ministries and departments should use PFMS platform for processing of payments for cash or in-kind transfers to individual beneficiaries as per framework laid down by Department of Expenditure. Implementing agencies shall generate electronic utilization certificates EUCs on PFMS portal and submit them online to certify that money was actually utilized for the purpose for which it was sanctioned to eliminate the need for physical generation of EUCs. Now, annual accounts. There are two kinds of annual accounts of the government. These are appropriation and finance. Rule 88 provides that appropriation accounts of central ministries other than Ministry of Railways and of central civil departments excluding Department of Posts and Defence Services shall be prepared by the principal accounts officers of the respective ministries and departments under the guidance of Controller General of Accounts. Controller General of Accounts will also supervise preparation of such accounts. These accounts shall be signed by the secretaries in the concerned ministries or departments. Union government appropriation accounts, civil, required to be submitted to Parliament shall be prepared annually by the Controller General of Accounts by consolidating the aforesaid appropriation accounts. Appropriation accounts pertaining to departments of posts and defense services shall be prepared and signed by the secretaries to the Government of India in the Department of Posts and Ministry of Defense respectively, and that of Ministry of Railways by the Chairman, Railway Board. Rule 89 provides that finance accounts of the Government of India, including transactions of Department of Posts and Ministries of Defense and Railways, and transactions under Public Account of India of Union Territory governments, showing under the respective heads the annual receipts and disbursements and statement of balances for the purpose of the Union shall be prepared and signed by the Controller General of Accounts and counter signed by the Secretary Expenditure, Ministry of Finance. Part 3 of this chapter, from Rule 92 to 95, is about Proforma accounts. Such accounts refer to the subsidiary accounts of government departments undertaking commercial activities whose operations cannot be suitably brought within the cash-based government accounting system. In such cases, subsidiary pro forma accounts are maintained as may be agreed between government and the Comptroller and Auditor General of India, C&AC. This includes the maintenance of suitable manufacturing, trading, profit and loss accounts, and balance sheet. I am skipping the details because these are quite simple and one may read and understand in normal course of reading. Part 4 of this chapter, that is rules 96 and 97, is about the personal deposit account. Rule 96 mentions that personal deposit account is a device intended to facilitate the designated officer thereof to credit receipts into and effect withdrawals directly from the account, subject to an overall check being exercised by the bank in which the account is authorized to be opened. In terms of Rule 97, the personal deposit account shall be authorized to be opened by a special order by the concerned ministry or department in consultation with the Controller General of Accounts only in respect of deserving types of cases as illustrated in Sub-Rule 2 of Rule 97. Part 5 of this chapter, from Rules 98 to Rule 103, is about capital and revenue accounts. Rule 98 mentions that capital expenditure is generally made from receipts of capital nature as distinguished from ordinary revenues derived from taxes, duties, fees, fines and similar items of current income including extraordinary receipts. Expenditure of a capital nature shall be distinguished from the revenue expenditure both in the budget estimates and in government accounts. Rule 99 provides for principles for allocation of expenditure between capital and revenue. Accordingly, capital shall bear all charges for the first construction and equipment of a project, as well as charges for intermediate maintenance of the work while not yet opened for service. It shall also bear charges for such further additions and improvements which enhance the useful life of the asset. On the other hand, revenue shall bear subsequent charges for maintenance and all working expenses. Expenditure on account of reparation of damage caused by extraordinary calamities such as flood, fire, earthquake, enemy action, etc., shall be charged to capital or to revenue or divided between them depending upon whether such expenditure results in creation or acquisition of new assets or whether it is only for restoring the condition of the existing assets as may be determined by government according to the circumstance of each case. Rule 103 provides that where loans outstanding against public sector undertakings are proposed to be converted into equity investments in or as grants in aid to the public sector undertakings, the approval of the Parliament to such proposals shall be obtained by including a token provision in the relevant demands for grants or supplementary demands for grants as may be found expedient. Rule 104 of Part 6 provides that interest at such rates as may be specified from time to time shall be charged in the accounts of all commercial departments or units. Rule 105 provides that the capital outlay made out of specific loans raised by government, the interest shall be charged at such rate as may be prescribed by government, having regard to the rate of interest actually paid on such loans and the incidental charges incurred in raising and managing them. Rule 108 of Part 7 provides that adjustments in respect of financial transactions with state governments shall be made in such manner and to such extent as may be mutually agreed upon between the central government and the state government concerned. However, adjustments with state government in respect of the matters such as pay and allowances, leave salaries, pensions, expenditure involved in audit and keeping of accounts, costs of police functions on railways, including the cost of protecting railway bridges, cost of forest surveys and forest maps, etc., shall be regulated by the rules contained in Appendix 5 to the Government Accounting Rules 1990. The rules are based on reciprocal arrangements made with the state governments and are therefore binding on them. As a convention, a period of 3 years has been accepted by the central and state governments for the re-audit of past transactions involving errors in classification in terms of Rule 109. In dealing with claims preferred by state governments under Clause 3 of Article 258 of the Constitution, the principles illustrated in Rule 115 shall be generally observed. In exceptional cases in which arbitration has to be resorted to, the Ministry of Finance will make the requisite arrangement. Further, in regard to transactions arising in connection with the agency functions entrusted to the state governments under Article 258 of the Constitution, the procedure illustrated in Rule 116 shall be followed. Rule 118 provides that services shall not be rendered to any foreign government or non-government body or institution or to a separate fund constituted as such except on payment. Rule 120 provides that when a government undertakes a service merely as an agent of a private body, the entire cost of the service shall be recovered from that body so that the net cost to government is nil. Rule 121 provides that any relief in respect of payment for services rendered or supplies made to any outside body or fund shall ordinarily be given through a grant in aid rather than by remission of dues. The incidence of charges relating to the maintenance and demarcations and disputes over boundaries between India and a foreign country is to be regulated by the principles illustrated in Rule 122. Rule 123 of Part 8 provides that a service department shall not charge other departments for services rendered or supplies made which falls within the class of duties for which the former department is constituted. However, a commercial department or undertaking shall ordinarily charge and be charged for any supplies made and services rendered to or by other departments of government. Rule 126 provides that the settlement of inter-departmental adjustments shall be regulated by the directions contained in Chapter 4 of Government. Accounting Rules 1990. Rule 127 reiterates the directions contained in the Account Code for Accountants General and mentions that the interdepartmental and other adjustments are to be made in the accounts year itself. Rule 129 provides that in the case of government departments and undertakings declared as commercial, adjustment of pensionary liability shall be made in the regular accounts by charging the average of the percentage for 15th year of service based on the rates of monthly contribution of pension as prescribed in the appropriate order issued from time to time under Appendix 2 of Fundamental and Supplementary Rules. With this brief account regarding Chapter 4 of General Financial Rules 2017, I would like to conclude my fourth talk. In my next talk, I will take up Chapter 5, which is on works and which ranges from Rule 130 to Rule 141. In order to keep myself focused on core and essential areas of rules, I have skipped rules 73, 75, 80, 81, 82, 90, 91, 100, 101, 102, 106, 107, 109, 110, 111, 112, 113, 114, 117, 119, 124, 125, and 128. One may read and understand these rules in normal course of reading as these are not difficult to understand, but they are a little lengthy. That's why I have chosen to skip them. I thank you for patient listening.